Do you think the SEC should go ahead with this pilot program? And if so, who should design the program, the SEC, or should they delegate this to the Committee of Exchanges like they did with the tick size pilot program?
Thank you, Ranking Member. Certainly not the exchanges. I mean, that's like putting the fox in the hen house, okay? So the answer to that question, I would like the SEC to design a pilot. However, I think the access fee program that's being proposed or been talked about falls short of one critical area. There should be a no rebate, as we call it, bucket. In other words, the source of the problems, the source of what we're talking about when it comes to fragmentation in various venues are the brokers. The brokers are routing at various venues to collect higher rebates. This doesn't make any sense for best execution. Rebates should not be taken into account. So what we think, a better model, rather than make or taker, is a flat fee. And actually, there is one exchange currently doing this, IEX, where they charge on their non-displayed liquidity 9 mils per share, or 9/10 of a penny, whether you make or take. That collects for them 18 mils, which is a nice revenue capture if you think about it. Based on the other exchanges, their revenue capture, since they have to pay a rebate and collect an access fee, is closer to 3 to 5 mils. So what I'm suggesting is a raise for the exchanges. I think they should deserve more money for matching against buyers and sellers. But rebates are distortive. They're clouding what brokers do. They're putting in unnecessary conflicts of interest. And that's just one part of payment for order flow. There's a second half, which we haven't talked about, and that's where the market makers who are off exchange will buy retail orders from firms like Charles Schwab and others, and they pay for that flow. They pay 9/10 of a penny, 15 mils, whatever, based on the agreement that they have with that broker. We want to know, why would a market maker pay for order flow? And they're giving price improvement, as Mr. Brown said. Well, obviously, there's a catch here. Market makers want as much order flow as they possibly can so they can read the direction of the market. But unfortunately, what this does is corrupts the order routing process from the retail broker side. And I'll give you one example of that thing that we really can't believe. There are some firms that can mark a retail order, okay? You can identify it going through an exchange, and you can get an enhanced rebate for that exchange. In other words, more money, if you are willing to give up the fact that your client is a retail investor. Now, what does that mean? Oh, retail only trades 100 shares. It really shouldn't matter, right? No, it does. You know why? Because it's not Mr. Lyon's order, and it's not my order representing an institution, and that means a lot. So what I'm saying is rebates, maker-taker, payment for order flow, these are all the sources of conflicts of interest that we've argued against for many years. So we're happy that the SEC has proposed this, but unfortunately, I think it may fall a little short of my suggestion. Thank you.
Did you have a chance to review that at all, or have any thoughts on that?
Congressman, thank you, and yes, I did, and thank you for introducing that bill. I think you were before the MSAC's committee on their proposal. Yours was 2015, I believe. So that's exactly what we're talking about. However, we are afraid of unnecessary complexity, again, seeping into the market, and some of them on the MSAC are proposing multiple buckets, they call it, in these pilots, similar to what we have in the tick size pilot. That's where more complexity starts to breed. I think we can do something when it comes to rebates and maker-taker in a more simpler form, as I mentioned earlier, with a flat take fee. But you also mentioned a couple of other really good points when it comes to order types, proprietary data feeds. You know, this whole maze and this whole web that we're describing, you know, we referred to it as a Rube Goldberg machine years ago. And, you know, the order, here's the buyer and here's the seller. They should be really easy to match up. But instead, they have to go through this crazy mechanism called the United States stock market. We can match up buyers and sellers. We need less intermediation. And what we have now is more intermediation, and we think it's unnecessary. Some of these things which causes more intermediation are these order types. Let's just take that for instance. For instance, one of the exchanges a couple of years back was fined $14 million because they did not display or did not disclose certain order types' behavior. $14 million is a significant fine by the SEC to a United States Stock Exchange. The reason being is that some clients can take advantage of those order types, while others can't. So it just, and I don't want to get into the weeds too detailed, but I wanted to read, you know, one quote. There was something that NASDAQ recently had out called a post-only order, okay? That order is, they changed the way they basically designed it. It's supposed to not interact with a current hidden order. So you can place a hidden order, you can place a displayed order. Why would they do that? Because they don't want to incur the access fee. So NASDAQ recently changed it and said, you know what, actually, we were giving away information on those hidden orders because the post only would slide down when it ran into a hidden order. Was that by design or by accident? I don't know. But for 7 years, that went on. Information leakage in the order types through the proprietary data feeds was going on. And this is what causes problems in the United States stock market. These are the issues that are really in depth.
All right. Thank you for that explanation. I wanted to talk a little bit about dark pools. And we recently had a case this year, January 2017, where the high-frequency trading firm Citadel was fined by the SEC about $22 million for misleading brokers who sent them retail orders, and Citadel had promised to give them the best price. Instead, they referred the trades to dark pools, and it turned out they weren't getting the best price for their clients. What's the best way to introduce some transparency to the dark pool situation?
Well, again, that situation was based on two sets of data, right? There's one set which is run by the SIP, the Security Information Processor.
Right. That's the slow feed, right?
That's the slow feed. Yeah. And then there's the other fast feed. That's the direct feeds that anybody can purchase from an exchange and then basically consolidate them all to build a faster quote. So the Citadel case was basically they were seeing one quote and giving the client a fill on an inferior quote. What's interesting about that is they pay for that order flow again, right, like we talked about before. But if you go back to 2004, Citadel actually wrote a comment letter urging the SEC to ban payment for order flow. They said it distorts order routing decisions, anti-competitive, and creates an obvious conflict of interest.
Right.
Well, what changed in the last 13 years that now makes it acceptable?
Right.
Any other comments on?
If I may.
Mr. Saluzzi.
Okay.
Go ahead.
I think that's interesting what Mr. Brown says, but all of his orders are being sold to various market makers, including limit orders, which I don't understand why a non-marketable limit order would be sold to a market maker when it could be posted on an exchange, but that's a different point. But the Citadel case that we described before shows that there are two sets of data. So not every time does mom and pop get in the right set of data. In other words, that SIP quote that they're looking to buy at the market may not be getting what the price that they're getting. But that's just one point. The second point is, you know, retail, we all talk about it, and I agree. 100 shares of, you want to buy AT&T? No problem. Put it through your retail account, you'll be fine. But retail also represents, you know, if everyone has a pension fund or a 401k, or I have a 529 for my kids, I've been saving for their college for the last 15 years. Well, that money is an institutional level. So that means I am a retail investor being represented by an institution, so I don't think we have to just say retail's never had it better. How is it that the institutions are doing? And I think Mr. Lyons explained quite a bit of a conflict when it comes to order routing and various other things going on in the market.
The fundamental question is, because you all are very distinguished, what can you tell us as members of Congress that we need to do to keep our nation strong and having the strongest financial, economic system on the planet?
Thank you, Congressman.
Yes, sir.
I can't agree with you more that trust and confidence in our markets are the most important thing we need. An old friend of ours, Senator Kaufman, used to always say fairness and transparency is the key here. And I agree. And what doesn't give me trust and confidence is that when I see, you know, major dark pools or ATSs getting fined multi-million dollars, when I see a stock exchange getting fined millions of dollars for various behaviors, or certain high-frequency trading firms also getting fined. So I think what's missing here, a critical link, is proper surveillance. And that goes back to the SEC. And in an attempt to fix that, they have recommended the consolidated audit trail, which is now being built, but it falls short in one key area. It only covers the stock and options market. It doesn't cover the futures market because that's the CFTC. They need to talk to each other.
Absolutely, and something that I'm not sure the people watching us this morning is quite aware, but I think that I want to bring to the attention of this committee that according to information that I have received, trading at traditional national venues like the New York Stock Exchange has gone down. That worries me. I see my time is up.
If I can, a real quick stat. Prior to NMS, 80% of share was done at the New York Stock Exchange of their listed stocks. Now it's less than 25 because of the fragmented maze of liquidity that's been created, mostly due to Reg NMS.
Yeah, thank you, sir.
This path seems to almost be closed. We've added to it with lots of regulatory burden, but this dynamic of liquidity, if you could comment on.
Thank you, Congressman. I think it's an excellent question, and I think it goes to the heart of the tick size pilot that has been approved and is currently implemented. All stocks are not equal, and this is a very important point. You know, it's not a one-size-fits-all market. So you may have a small-cap company that's doing great and they're growing and so on, but they don't fall under the radar of a large investment manager. So they're trying to get their self-known, and maybe they're looking for analysts to cover them, but nobody wants to make a market in that stock anymore because it's not profitable. So the tick size pilot came out and said, how about if we widen the tick to a nickel and to see if we can encourage real liquidity providers to come in to support the name. Now the facts are still not known on the tick size pilot. As much as the industry wants to say it's a failure, I don't believe that's true. I think it's starting to work, but what's happening is you have to change behavior amongst traders like myself, which we've adopted to it very easily. But what happens is there's a lot of algorithms out there, and they haven't figured out that you can go in there for more size. There may be more liquidity. Instead, what they do, the average trade size in the United States, which trades 6 to 7 billion shares a day, is 200 shares. That's lit or dark. So that's a very small amount. What needs to happen is behavior will change, and I think it will, and it will prove that the tick size pilot could help those small cap companies.
Thank you, Mr. Saluzzi.